By Real Estate Rank IQ, we asked the world's most advanced AI for 2026 housing market predictions. The results? 6 total shockers. Let's roll the video.
We asked the world's most advanced AI for its 2026 housing market predictions, and what it came back with were 6 absolute shockers. So, which of these predictions could totally flip how you think about buying or holding property over the next few years? You're definitely going to want to stay until the end because the last one is the most shocking of all. But before we get to the predictions, we need to understand what the AI was even looking at. So let's start with the big economic signals that are shaping the entire national housing market for 2026. Okay, let's get into Act 1, the macro context. See, to get a clear home price outlook for 2026, you can't just look at house listings. You have to start with the massive engine that drives everything, the US economy. So the big story the AI is flagging for 2026 is this idea of stagflation light. What on earth is that? Well, imagine the economy stuck in second gear. GDP growth is sluggish, running below that typical 2% trend. But at the same time, inflation is still uncomfortably high. It's not a full-blown crisis, but it's this annoying, persistent drag on everything, mostly thanks to those lingering supply chain headaches and all the global economic weirdness. And this inflation challenge is a really big deal. The AI is forecasting that core inflation in 2026 is just going to stubbornly hang out above the Fed's 2% target, hovering right around 3%. Now, a huge piece of this puzzle is something called owner's equivalent rent, or OER. Just think of it like this. It's what a homeowner would have to pay to rent their own house. It's a massive part of the consumer price index, and since it lags behind real-time home prices, it's going to keep pushing that overall inflation number up all year. So with inflation still running hot, what's the Fed gonna do? Well, here's the Fed interest rate outlook for 2026, and it might surprise you. The AI actually sees the central bank cutting interest rates, maybe 2 or 3 times, trying to land that federal funds rate somewhere between 3 and 3.5%. Now you're probably thinking, wait, why would they cut rates if inflation's still high? The answer is the job market. The Fed's walking a tightrope, and they're willing to accept a little more inflation to keep hiring from falling off a cliff. This is absolutely critical for any mortgage rate forecast for 2026. And here, you can see that balancing act in action. While hiring has definitely slowed down, the AI doesn't see a total collapse. It's forecasting that the unemployment rate will kind of level off around 4.5%. Now, yeah, that's higher than the crazy lows we've seen, but it's still what most would call a pretty tight labor market. The big takeaway? The economy is cooling, for sure, but it isn't cracking. And that context is crucial for everything that comes next. Okay, so that's the big picture economy. Now, for Act 2, let's zoom in on the housing equation. This is where we see how those huge forces, stagflation light, that sticky inflation, and the cooling job market, actually translate into what real...
Here's a pro insider tip. Watch the 10-year Treasury. Mortgage rates move with it. When yields drop and spreads tighten, that's your cue to lock in.
Buyers and home sellers are going to feel on the ground. Now, this right here, this is the heart of the housing affordability story for 2026. The AI is predicting that for the first time since the Great Financial Crisis, we are going to see a sustained period where people's incomes are actually growing faster than home prices. Sure, nominal home prices are still inching up. The forecast says about 1.2%, but wages are set to climb even faster. And that means even though the sticker price on a house is going up, our actual ability to afford it is slowly but surely getting better. It's a subtle change, but believe me, it is a massive shift.
Okay, here is another pro insider tip. Track local micro trends. Every month, follow 3 signals: active listings, price reductions, and rent concessions.
And here's the payoff for that shift. The AI projects that the typical mortgage payment as a percentage of a person's income will finally dip below that critical 30% affordability line, landing at 29.3%. This is the first time we've been under that threshold since 2022. No, it's not a huge drop, but it's a slow, grinding improvement that might just be enough to bring more buyers back off the sidelines. But there's a huge anchor dragging on the market. This is the powerful lock-in effect, and it's a huge part of the housing inventory forecast for 2026. Check this out. Something like 70% of homeowners in the USA have a mortgage rate under 5%. They're basically wearing what people call golden handcuffs. Their current deal is so good it makes moving almost impossible. I mean, why would you sell your house with a 3% mortgage just to buy a new one with an interest rate of over 6%? You wouldn't, unless you had no other choice. And that is keeping the number of homes for sale incredibly low. And that lock-in effect creates this really fragmented consumer landscape. It's one of the defining real estate market trends for 2026. The AI basically sees three different groups. You've got the haves, the top 10% of earners, often repeat buyers who have a lot of cash or equity. They're still driving the market. Then you have the have-nots. The share of first-time homebuyers has crashed to an all-time low of just 21%. And finally, there's this new group popping up, the renters by choice. These are people who could maybe afford to buy, but they're choosing flexibility and lifestyle over a mortgage. So, before we get to the big reveal, I think it's important to quickly peek under the hood at how the AI came up with all this. It's not just random guesses, it's a logical process. First, it sucked in all that macroeconomic data we just talked about. Second, it modeled the core housing dynamics. Affordability, inventory, how people behave. Third, it analyzed all the key differences from one region to another. And finally, it put it all together to come up with the most likely outcomes for the national housing market in 2026. And that brings us to the main event, Act 3, the reveal. So here they are, the AI's 6 most shocking 2026 housing market predictions. This is especially for anyone out there wondering, should I buy a house in 2026, or trying to map out a real estate investor strategy? All right, kicking off the countdown at number 6 is the refuge market boom. And this one points to a massive geographic reshuffling of the USA real estate market. So what does this mean? Basically, the AI sees those pandemic darlings, cities like Austin and Nashville, finally starting to cool down, and taking their place, a new set of what it calls refuge housing markets. Think affordable, climate-resilient cities in the Great Lakes and Midwest, like Cleveland and Syracuse. Why? Well, buyers are getting smarter. They're actively looking for value and stability, and they're moving away from places that are super expensive or have high climate risks. This is a huge deal for homebuyers who are priced out of the major hubs and for investors looking for the next growth zone. The bottom line here is that the list of the best cities to buy a home in 2026 is being totally rewritten. Coming in at number 5. This is a big one that signals a fundamental change in the American dream. The AI calls it the end of the starter home. Get this, the AI says the median age for a first-time homebuyer in 2026 is 40 years old. 40. That traditional path of buying a small, modest starter home is pretty much going extinct. Instead, the new ways people are getting into housing are things like co-living, moving into multi-generational homes with family, or just accepting that they'll be renting for a very long time. It's all because the high costs have made that old dream impossible for so many younger people. This obviously hits Gen Z and millennials the hardest, and it's forcing the entire single-family housing industry to rethink everything. The big implication? The American dream of a starter home is being replaced by something new, something more collaborative. Prediction number 4 shows that we can't really talk about a single US home price forecast anymore. The AI calls this the Great Regional Price Divide. So, the big question, will home prices go up or down in 2026? The AI's answer is pretty clear. It completely depends on where you live. The national market is splitting into 2 totally different stories. The model sees sharp price drops. We're talking 5 to 10% in about 22 major cities, especially those pandemic hotspots like Cape Coral, Florida, and Austin, Texas, where a lot of new inventory is suddenly hitting the market. But at the same time, more stable, affordable housing markets like Chicago and St. Louis are expected to see modest price growth of 2 to 4%. That single national number you hear on the news, it's becoming pretty much meaningless. Shocker number 3 uncovers a wild split happening within the U.S. rental market forecast. It's a trend the AI is calling the renter's revenge. Just look at the difference in the rent growth forecast for 2026. If you're one of the millions of people living in a big apartment building, some serious relief is coming your way. The multifamily construction outlook is strong, there's a ton of new supply, and the AI predicts rents in that sector will barely budge, rising just 0.3%. But if you're renting a single-family home, it's a completely different story. That inventory is still super tight, and those rents are expected to climb by 2.3%. This massive split is going to be a huge factor in the rent versus buy decision in 2026. And now for our runner-up, probably the most counterintuitive prediction of the whole list. Shocker number 2 is what the AI calls a sales surge that isn't really a surge at all. So you're going to start seeing headlines screaming about a massive 14% surge in home sales in 2026. And while that number is technically true, here's the catch. It's coming off of historic, multi-decade lows. The total number of homes sold will still be millions below what we thought was normal just a few years ago. That golden handcuffs lock-in effect is just too strong to overcome. So this is going to mess with real estate professionals and anyone hoping for a real boom and more mortgage refinance opportunities. The takeaway here is all about managing expectations. The market will feel busier, but it's progress, not a party. And that brings us to the #1 most shocking prediction from the AI. As this quote from Realtor.com puts it, the sticker price of homes, the number on the for sale sign, it's going to keep going up. But, and this is the important part, because overall inflation and our incomes are rising faster, the real inflation-adjusted value of homes is actually set to fall for a second year in a row. This is the absolute key for anyone thinking about real estate investments. Your home's price on paper might go up 1.2%, but if inflation is at 3%, your actual wealth, your real equity, has gone down. This quiet erosion of real value is the biggest, most misunderstood story of the 2026 housing market. For deeper breakdowns and tools to help you track these shifts, visit Real Estate Rank IQ.